Hello and welcome back to our monthly market update. My name is Ed and I'm one of the traders here at Northern Gas and Power. Asian demand continues to dictate prices seen across the UK and European markets. A high level of Asian demand leads to increasing competition for LNG cargoes between the two continents, meaning the UK must pay a premium to the Asian market in order to attract LNG cargoes to our shores. Norway is one of the largest exporters of gas to the UK. We rely heavily on supply from the Norwegian gas fields to make up any shortfall in UK demand. Maintenance at these Norwegian gas fields causes disruptions and limits the total export capacity of the pipelines, thus creating a fear of lack of supply in the UK markets, leading to price increases across both fuels. The UK and European market continue to rely on gas imports to balance their demand and fill storages heading into the winter months. With the Nord Stream pipelines out of commission, LNG cargoes become a solution to the supply hole, a lack of Russian gas left. Previous years have seen an increasing likelihood of extreme weather across the key economic hubs on the European continent. Heat waves have a double effect of restricting power generation supply and increasing demand, both of which spur prices to high levels. The Middle Eastern conflict remains of paramount importance, since any escalation would increase gas and power prices across the curve. We have already witnessed implications caused by the geopolitical tensions, with LNG cargoes now being diverted from their typical route of travel through the Suez Canal to now routing through the Cape of Good Hope, which adds 6,000 nautical miles or 3 to 4 weeks to delivery times. July experienced cooler than average temperatures, a heat wave, and rain to finish at about seasonal average. August too is predicted to bring a mix of conditions, with significant rain and storms expected in early August, followed closely by a mid-month heat wave, before going back to changeable. Storm Debbie has become active in the Gulf of Mexico, growing to a Category 1 hurricane and forecast to bring heavy rain to Florida, South Carolina and Georgia. Typhoon Gamy in the Western Pacific is likely to impact Taiwan, and the Atlantic hurricane season is likely to be above normal according to the NOAA and has the potential to impact the supply of LNG to the UK, Europe and Asia. Oil prices fell 7% over the course of July, reaching a high of $87.43 per barrel at the start of the month, before shedding value over the remainder of July to a low of $78.63 per barrel. Oil prices are expected to remain under pressure as uncertainty surrounding Asian demand recovery continues to hold a cloud over the market, as China's July demand output turned at 10.53 million barrels per day, or 7.3% lower than June's demand. Despite continued geopolitical tensions and high interest rates, the World Bank expect the global GDP growth to stabilise at 2.6% this year, holding steady for the first time in 3 years. Continued recession fears are adding bearish pressure to the market as crude holders offload at the fear of slower economic growth. The month of July was a month of two halves in the forward electricity markets, as prices fell during the first half, then picked back up towards the end of the month, with the Winter 24 contract trading within a £6.85 per megawatt range. The Winter 24 contract settled at £87.31 per megawatt hour at the end of July, a 2.1% fall from the end of June. Moderate increases in the front season sees the contract jump above the price at which it started the year. We see the market re-entering the 2023 era of backwardation of the power forward curves. Backwardation, the opposite of contango, refers to the future dated contracts delivering at a cheaper cost than the prompt. This impact is most noticeable in the summer. A summer 25 contract trades at a 14% premium to the summer 26 contract. Total demand throughout May averaged approximately 22.7 gigawatts, unchanged from last month's average demand. Temperatures struggled to increase throughout July, alleviating the requirement for additional cooling demand. Wind generation averaged 4.8 gigawatts for July, 1.7 gigawatts short of seasonal averages. Subsequent of this, the UK nuclear generation has averaged 4.8 gigawatts to meet the required supply gap. Low wind generation provides bullish support to power day ahead prices. Gas was used to generate 7.7 gigawatts of our power to offset any supply shortfall. Wind generation has been seasonally low. There is an inverse correlation when comparing gas for power generation with wind speeds. The gas forward contract for delivery in Winter 24 fluctuated throughout July, similar to its power counterpart, with prices falling by over 6 pence per therm at the start of the month and rising by 7.22 pence per therm during the last week of the month. The Winter 24 contract peaked in the final day of July, trading at 100.6 pence per therm, a level which saw a gain of 1.79 pence per therm from the beginning of the month. Volatility was replicated across the corresponding curve products, although there were smaller price movements in each of the subsequent 4 seasons, particularly for contracts past 2025. Gas storage across the EU continues to be re-injected at a steady pace, with fullness having increased from 77% to 83.5% throughout the month of July. The storage situation does offer some bearish sentiment to the market, although this must be offset against the increased global competition for LNG shipments from the American and Middle Eastern markets. UK's total gas demand decreased from an average of 90 MCM per day in June to 88 MCM per day in July, constituting a total reduction of 2.3%. Despite total demand for gas within the UK remaining fairly stable, local demand fell 7 MCM per day from June 24, representing an 11% decline. However, gas for power demand moved the other way, increasing 5 MCM per day over the month of July to 28 MCM per day. Total gas demand through 2024 so far has declined by 5.3% compared to the same time period in 2023. This continues a trend of gradual demand destruction and energy efficiency across businesses and households. The anticipated scenario entails a market that remains range-bound but tentatively bearish. We've observed the establishment of a support level around the lows experienced in mid-February and a price ceiling in early June. Pan-European gas storage remains healthy for this time of year in the high 80% of capacity region. Increased likelihood of heat waves. Potential of reduced power station capacity alongside higher requirements for air conditioning. US election. Potential limits on future LNG build-out on energy independence concerns, although a recent court case has now blocked the pausing of LNG infrastructure build-out. Price-led US production cuts. Potential for some downside in cross-Atlantic LNG flows if the mid-February price floor is approached. Increased Asian LNG demand. Prices are now significantly below longer-term oil index contracts, and as such are incentivizing spot purchases of LNG from Asia. Thank you for watching this month's market update. Be sure to follow us on LinkedIn for more.